Welcome to Stony Finance Lab channel.
Hello everyone, we are Kuan-Yin, Wei-Jiuan Chang, and Bingqin Shao. We are going to talk about the topic, how passive investment makes your dream come true. Firstly, let's start with the background. Our targeted investor group is graduate students who study in the computer science or closely related field and are leaving campus to join the workforce in Texas. About the investment goal, we said that those targeted investors would invest and save to buy a new car that will cost around $45,000 in 3 years. As for the investment vehicles, we'll introduce you to the three main asset classes of traditional financial assets. Firstly, the money market instruments, which include the bank certificates of deposit, T-bills, commercial paper, and etc. The investment horizon is typically less than 1 year. Secondly, about the bond, a capital market debt instrument, and its investment horizon is ranging from 5 to 30 years. Thirdly, as to the stock, it's an ownership stake in an entity or residual cash flow. Last one is others, like real estate, private securities, and digital assets. In this case, the main investment vehicles we are going to use are ETFs. Exchange-traded funds, ETFs, work just like mutual funds. A large pool of investor dollars are put together to purchase assets with the goal of creating gains. Also, as with mutual funds, participants proportionally share in gains and losses generated by the ETFs. ETFs are publicly traded on the open market and sold just like an individual stock, and ETFs are commonly based on an index. Then let's talk about the taxable accounts and the tax advantage accounts. The taxable accounts don't have any tax benefits, but they offer fewer restrictions and more flexibility than tax advantage accounts, such as individual retirement accounts, IRAs, and 401ks. Unlike an IRA or a 401k, with a brokerage account, you can withdraw your money at any time, for any reason with no tax or penalty. A brokerage account is an example of a taxable account. In respect of the tax advantage accounts, they are generally either tax-deferred or tax-exempt. The tax-deferred accounts, such as traditional IRAs and 401k plans, provide an upfront tax break. You may be able to deduct your contributions to these plans, which provides an immediate tax benefit. You pay taxes when you withdraw your money in retirement, which means the tax is deferred. The tax-exempt accounts, including Roth IRAs and Roth 401ks, work differently. Contributions to these plans are made with after-tax dollars, so you don't receive the simple upfront tax break like you do with traditional IRAs or 401ks. However, your investment grows tax-free and qualified withdrawals in retirement are tax-free as well. That's why these accounts are considered tax-exempt. Here's a rundown of where tax-conscious investors might put their money. Why choose a taxable account? Because taxable accounts are funded with after-tax dollars, the amount used to purchase the assets and any earnings paid to the accounts create a tax-free stream of income. When investments such as stocks and real assets are sold, only the gains will be taxable and will often be taxed at lower capital gains rates. Second part is the investment strategy. Let's begin with how much does an entry-level computer science make in Texas. The average annual pay for an entry-level computer science in Texas is $42,235. That works out to be approximately $20.31 an hour. This is the equivalent of $3,520 a month. About cost of living, the average person in Texas spends about $1,732 a month on expenses. It contains about 3 categories. In Texas, the average rent for an apartment runs around $910 a month, and the person spends almost $560 on food per month based on the average level, with about 2/3 being spent on groceries and rest on eating out, and the rest of money is used on transportation. Each targeted investors will have disposable income about $1,790 per month. We will take a passive strategy since the targeted group may not have financial knowledge and enough time to focus on the market. We mainly invest in ETFs with a monthly investment of $1,000, about 28.4% in SPY, 42.7% in QQQ, and 29% in BTI. The analysis of return and risk. Based on monthly historical returns of the three ETFs over the past 5 years, we assume the portfolio has a monthly expected return of 1.81% and the potential risk, the standard deviation, is about 4.58%. The portfolio is negative skewed. Left skewed, meaning that the mean of the data is less than the median. Also, its 1 month 95% bar equals minus 0.0722. Indicating that as investing $1 in this portfolio over the horizon of 1 month, investors may gain more than nearly $0.0722 with the probability of 5%. As investors invest $1,000 every month for 3 years, the investment will be worth $15,136. And after deducting the 15% capital gains tax rate for the taxable account, investors will still have nearly $48,000 left, which is totally enough to buy a new luxury dream car. Mistakes to avoid and principles for success. Mistakes to avoid: not understanding the investment, legal passions, attempting to time the market, failing to diversify. Principles for success: create clear appropriate investment goals, maintain perspectives and long-term disciplines. Pay attention to all your monetary outflows. Finally, the summary. Though you are only new graduates, you can still earn great profits from investing a fixed amount of money every month. Even with a passive investment strategy, you could buy your own dream car. Only if you avoid the mistakes and stick to the principles we have mentioned above, you can realize your dreams sooner. Here is the reference. This is the end of our presentation. Thank you.
Thank you for watching this video. Please feel free to like, comment, and subscribe to this YouTube channel.